people hear of land tax and they sort of, there's a bit of in the past you might have got a $200 land tax bill. They're like, these are tens of thousands of dollar bills.
Yeah, look, up
property.
to $1 million, it's probably absorbable by most people in terms of your land value. It's based on your site value as assessed by the council, but it's a sliding scale, and once it gets up, they're good problems to have for these people. They're talking about a $2, $3, $4 million land value. They're not poor people, but they may be cash poor. Yeah. And this properties, they've been lucky enough to have had it through the family for 50 years.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners.
So today's podcast is, we're talking all things property. We always make the mistake of talking too much before we start the recording. But today's guest, James Mcgrath. Jim? Is it Jim or James? What do you prefer, mate?
Either or, mate.
Okay. And Simon Edwards from WBP Group. Thanks for coming in this morning, guys.
No problems.
Thanks for having us.
Now, Job, who's off camera at the moment, Job's been giving us, he set up this morning and he's given us a little bit of feedback, Ben, on the podcast. And one of the things that he said is that we talk too much shit, and that perhaps we could set up a bit of context around what we're going to talk about during the podcast. So I made a couple of points, and Simon sent me through a couple of notes as well beforehand. But the aim of today is really understand a couple of things, and they are the role of a valuer. So I don't think you guys can do a bit of an introduction in a second about who WBP Group is. But we're talking valuations, we're talking the role of a valuer, when do we engage a valuer, the cost of no advice or bad advice, which I think we can probably all relate to, Ben.
Yep.
And then maybe from a financial planning perspective, I know the things that clients ask us a lot about how valuations impact things like tax and your investments. And we're going to stretch into your thoughts on the current property trends, particularly in the areas that you're looking at through Geelong, Surf Coast, Ballarat Peninsula, southwest Victoria. So that's my intro. Job, I hope that's okay for the setup. Let's kick it into gear. Simon, Jim, tell us a little bit about how you got into property, a little bit about WBP Group, and then we'll launch into some of those answers to those juicy questions. Jim, over to you, mate.
Sounds good. Thanks for having us. I guess to start broadly, WBP Group was started or founded by Patrick Brady, Bill Wolstab and Greville Pabst about 30 years ago, I believe. Simon and I've worked at WBP for 11 years, I think, as a total, and Simon about 20. And in 2020, I moved to Geelong, and subsequently Simon and I bought the Geelong entity. So we sort of siphoned it off from the broader business, and now Simon and I run it as our own business in partnership with Patrick and Greville from Melbourne. And yeah, my background, I guess I started at WEP in uni, so as a work experience was my first role.
What did you do at uni?
Property.
I did.
Yeah. Yep.
What's the actual degree?
It was a degree in property valuations, I believe.
Okay.
Property and valuations. There was only about 15 of us in there.
Yeah.
It started out at RMIT. The first year was construction management, project management, property and valuation as like 4 integrated into one. It was about 200 students. And then from that year onwards, you could mix and match. If you liked one better, you could sort of change. They didn't make it too strict. I stayed with valuations, didn't really know what I was doing.
Did you always have an interest in that though, or not?
A little bit, but my father sort of was always like, I should have got into property, like you should have a look at it. And then I had a cousin who was a valuer, and I'd sort of spoken to him a little bit, and I liked the idea of not being stuck at a desk all day, bit of outside, get to have a look around. So that was always something that appealed. And then, I ran into a guy at a country race meeting who was a valuer, and he hence then got me looking at WBP, went in for a chat, found out that Patrick actually went to teachers college with my old man, And
Your old man knows everyone, I think.
yeah,
a
and
country thing.
it is. And he's like, "Oh, is he still up at Port and all this?" And the interview didn't even really talk about me or property. And they said, "Well, we don't really have many roles at the moment. We can give you some work experience." I said, "I'll take that." And it was sort of like 1.5, 2 days a week that I didn't have uni. So they said, "You can come in for that time." I did about probably 6 months, and the CEO at the time, Brendan Smith, gave me about $500 cash for that work experience. And they said, "Oh,
We're supposed to pay work experience people, are we?
I don't know."
I was just asking.
Yeah, and then there was a role opened up for a single cadet, which was the only one they had in the Melbourne office role at that time. And I was like, "Yep, I'll jump at that." And from then on, it's pretty much history. Went through, got qualified in about 2015 as a residential property valuer, so you can only do sort of residential property, and then subsequently did some more training, upskilled, and then in started 2017, become a certified practicing valuer, which basically you can do everything, commercial, etc. And yeah, now we're here where we are today.
Beautiful.
What about you, Simon? Did you get your gig at the racetrack or not?
No, I sort of fell into it. I'd got a reasonable score at school, but never knew what I wanted to do. Went to uni in sort of a generic business degree. Took some time off, travelled a bit, ended up starting work as a real estate agent, which I didn't enjoy. Certainly not the best agent going around, but it did expose me to property. And I met a valuer on site. They were doing a mortgagee auction or something like that, and got chatting to them and thought, yeah, I think I'd be more suited to this, dealing with facts rather than opinion and personalities to a degree. So yeah, finished off my course, or pivoted a little bit, and then got a job fairly easily. Was lucky at the right time, I think.
This is all in Geelong?
No, this was in Melbourne with WBP. They were just growing. They'd started a big contract with one of the big banks, so that it enabled them to hire some people. I was one of them, and shortly after they offered to set up in Geelong, and I took that opportunity and moved down here, and I haven't looked back. I've really loved it.
So was WBP Group your original foray with them? It wasn't a cadetship like Jim, it was...
No, I was towards the end of my degree, and I think the rules about who could sign off reports and what was happening was a little bit more lax before James got there. So, no, they threw us in the deep end as much as they could, which was great. It's the best way to learn, I think, is on the tools.
Is it a highly regulated, just on that quickly, is it a highly regulated industry now or profession now?
It is. It's certainly trying to be. The barriers to entry are getting less. There are some ways to get into the industry that don't allow you to do everything, but they allow you to do some things. To become a certified practicing valuer, there is a fair bit of work. It's equivalent of becoming a CPA accountant, I guess, something like that along those lines. There's an industry interview. You need a couple of years' experience, and obviously your qualification.
When did the two of you meet?
Whenever James joined the company, I'm not sure when that was.
Probably one of the first Christmas parties that Simon travelled up for, and would have been maybe 2013 or 14, I reckon. We probably met at that time, and yeah, we always got along well. And then when we moved down here, I was actually Simon's boss for the start. I was sort of covering Geelong and the west of Melbourne as a
title only.
As a regional manager, and then the opportunity sort of came to us to buy into the business, and then we subsequently had some more serious chats, and we always got along well, so there was never really any worry about how we go in business.
So when did you become business partners? How long ago?
Probably the start of the process was probably 4 or 5 years ago now. It took a couple of years to get all the documents and agreement done with the head group. We went through all that together, and you learn a fair bit about each other.
You do.
Through that. Now I speak to James just about more than I speak to my wife. We're on the phone probably 5 or 6 times a day. We've got a great relationship.
Well, let's dive into what you guys actually do. So, in terms of understanding property valuation, for the lay person, what does a property valuer actually do? What are the distinctions between types of property valuation?
So the role of a property valuer is to provide independent advice. A good valuer should have a pretty high level of experience in the area they're working in, and they should be completely unbiased. That's sort of the standard you want to reach. We shouldn't have any preconceived notion of why or what sort of figure we're valuing a property at. It should be completely independent, and that separates us from a real estate agent's opinion or your neighbour's opinion.
Or your own.
Or your own, yep, to a degree.
And so that's probably the issue. People always overvalue their own assets. But also when an agent is looking at it, depending on the market, they're thinking about what they could potentially sell it for, which is a very different thing, isn't it?
It is. There's also instances where people undervalue because they're not aware of zoning or different elements of what might be planned to be happening in the area. So, without that intimate knowledge, I suppose people can undervalue their property and be unaware of what they're sitting on or what's possible.
I suppose there's some quirky properties too with different overlays or, like you're saying, zoning permits and things that are around it as well that people would not understand.
Absolutely. There's a heap of unique properties around Geelong, particularly along the coast as well, where there isn't a lot of similar data to draw from. So you'd need someone with experience and expertise in that market who knows what's happening and what drives it to put a figure on it for various purposes. There's some great real estate agents around, but ultimately they've got a different objective, and they're not liable for what they say. So they may be trying to list the property, or they may realise that, hey, I'm not getting a fee for this just to provide an opinion, so I'm not going to put the work I need to do it. And they're not land economists. They are basing it on feel, and it's not necessarily wrong, but it's a different process to what we do.
So other than real or perceived conflicts of interest with maybe an agent valuing a property, what are the other reasons that people get property valuations wrong? Like what are the other obviously emotion of someone who wants to get more or think that their property's worth more than it perhaps is. Are there any other key factors that people get wrong when they're valuing their property, either themselves or having someone else to do it for them?
Probably the reliance on the wrong data, or the data that they want to make fit their argument that they may not even know is already in their head. So there is, particularly now, we're in 2025, you can go online and do free searches about your property, your neighbour's property, and you'll get an estimate that's driven from somewhere. You could rely on that. You probably shouldn't. But you can also, if I want to think my house is worth $1.5 million, I can remember the one 2 years ago that sold that was similar and they got a great price, and I go, yep, that's great.
I think they call it confirmation bias.
That's right. But in reality, the market's changed since then. I've ignored all this other stuff that I don't want to see, and it can be the other way too.
Yeah. I think that's on top of that. The biggest one is understanding the market. Like, how many valuers go out to an auction on the weekend and understand what's driving it, how many people are there, what sort of property is it, was it well received, was there 50 people there, 5 bidders, were there 50 people there, no bidders, were they just all sticky beaking? Understanding those intricate elements of the market, which I'm not sure a lot of people or a lot of valuers go to the extent and do. And if you live and work in the area, that should be something you should be doing. And I think that's one of the biggest ones, that if you live and work in the area, you're usually passionate about it, and you'll go to that extra step to make sure you're across all the data. Whereas other people that might fly in, fly out, you just miss so much. You don't have relationships with the agents locally, council, any other elements that you might think of, which are incredibly important.
I actually went to an auction last Saturday in Point Lonsdale, and it was a mortgagee auction. So the bank had possessed the property, and the old adage used to be, it's a mortgagee auction, it's a fire sale, we just get rid of it for whatever we can. And it's not true. The bank has to follow a process. They really don't like doing it. It's a horrible look. But there would have been a valuation done on the property to set a reserve or a range. Anyway, the auction went and it did sell. There was 2 bidders. It sold for just under $900,000. And as I walked out, some guy was on the phone and he said, that was a effing bargain. And I thought about it, and I was driving home. I thought, well, perhaps, but let's look at the history of this property. It had been advertised by another agent for 1.1 million for about 12 months. Nothing had happened. Then they've changed tack. The bank's taken over. They've got an independent valuer to come in. Then they've advertised it for 6 to 8 weeks with a price range for public auction. So the market's been well and truly tested. We've got 2 bidders here, and it may look cheap from what you used to 12 months ago, but right now this is a fantastic test of the market, and that's what it's paying.
I think that's one thing that people get caught up on what was prior and what they think it will be in the future, rather than just assessing it at that point in time. Like even at the moment, people start to talk about interest rates coming down, and they start to get a fear that the prices are going to run up rapidly on property. So now they've got to start buying. There's going to be people who pay overs in the next period of time, I think, to get property that they shouldn't.
But potentially the COVID boom has distorted the
reality.
Market. Yeah, and reality.
Yeah.
After interest rates started rising in mid 2022, it was a pretty quick turnaround, and it stopped. And I haven't seen anything like it in 20 years of doing this. And I don't think I'll see anything like it again. So we're nearly 2.5 years beyond that first rate rise, and the market's still settling. I think Geelong's come to a point where it's just trading as a normal market, but that coastal market that had the biggest boom is still in a settling period where we're trying to work out exactly where the true levels of value lie.
Would you have had basically a decade of market movement though within a 18-month period or something ballpark like that?
There was, I think the hottest market in that time was Point Road Night in Anglesea.
Yeah.
And it was 70% growth in the space of 18 months.
Yeah. It's absolutely crazy when you look at the numbers. But the problem is that people think that's norm and that it will happen again. And it could happen again.
Well, I think it's, for me, I reckon it's demographic based.
Yeah.
So you look at it, I'm 34. I reckon people, say 40 and under, haven't really experienced a tough property climate. Like, they bought property, say, around 30, just watched it go up, going, how good's this? You just buy property, it just goes up. Interest rates at a pretty reasonable level, not too much economic instability, away you go. And then all of a sudden, interest rates triple within 18 months, market cools, as a general rule, probably minimum 20%. You get chucked in with how many extra taxes from our government? Yeah. Like, everything's been tipped on its head massively.
Yeah. And then those people still think, again, this is what I hear this and said, is that they think that this would just swing back again the other way though. Like it's probably, they just look at the interest rates on the surface, but they don't think about the taxes and the, tenant change, like rules for landlords and all of the other factors that go into it that you guys are assessing all the time when you actually look at this stuff.
I think they are looking at it now, particularly that coastal market where land tax has smashed people who are holiday homeowners, or it's a generational family property. It's been in the family hands for 40 years. It might be worth $3 million. Now they're getting slugged with this land tax bill, and they're not on huge incomes. They don't have cash flow. They have family wealth, and they can't hang on to it now. And the problem is that there isn't a heap of buyers looking to replace them because they're going to have the same problem unless they're owner-occupiers. So the number of owner-occupiers buying in Lorne, Anglesea, Aries Inlet, Point Lonsdale is below the number of properties being advertised, and we're seeing a bit of an adjustment, like a proper adjustment. And this is the first real correction that I've seen in my entire career, really.
It might be a nice segue into, we talked about valuations in sort of selling a property, but you mentioned sort of land tax. Maybe let's talk about one of the other reasons that people are getting valuations. So what are the main reasons, other than you're about to sell a property, you need some independent direction on the value? What are some of the other reasons we would need to engage a registered valuer? What are they?
There's a variety. There's obviously the pre-sale one's common, but the pre-purchase one. So, you found a property, you might already be dealing with a buyer's agent, but you might want a secondary opinion. So pre-purchase, different tax that we've just mentioned. What else we got? Different estate planning purposes, family law separation, asset review. So you might have a variety of different assets in your portfolio that need to be reviewed for super or any other instances like that.
Yeah, so there's a lot of valuations that need to be done to tick a box for the SRO, the tax office, and we certainly do those, but we feel our expertise is more in that estate planning, private stuff. So you've got, like we said before, a family property that's being divided up between 2, 3, 4 beneficiaries, and having someone experienced in the local market to put a figure on that can save you, well, there is a fee attached to it, but it will save you money, it will save you time, it will save you family relationships potentially.
It's the dispute part, isn't it? Because we were just talking before we jumped on. Yeah, that example is coming up more and more often, is the family home plus some, other liquid assets dividing up 3 ways, but one of the kids wants to take the family home on. I had one the other day. They just got a quick valuation from an agent, and it's funny that it's always just around 600. 700, like it was just bang, that was it, and then they're going to take that as gospel. But the chances of that becoming a huge internal family dispute is pretty high without getting a true valuation of that property.
You see it all the time, and it may not be initially straight afterwards, but it might be 3 or 4 years down the track.
It's just the people around the outside of it who start to chime in on it.
Yeah.
Well, it kind of speaks to the value of independence, and I mean,
that's it.
The correlation between what you guys do and having an independent view on a client situation. And the things that immediately come to mind for me are some of our clients that have had either family law disputes, or we have estate planning issues where you need to be, as clients, they need to be removed. Ideally, we want to be emotionally unattached to the decision about what the property is worth. Having someone else impartially come and provide that, I think, is invaluable. And I know we've talked about this off air, but the value of that far outweighs the cost of actually going and getting someone to do that. I think family law is another big one. When you have disputes and people are in disagreement about what something's worth, what an asset is worth, having someone impartially provide that, I think, is extremely valuable.
And what we provide in that instance is more than just a figure. There's a heap of commentary about what's happening in that, specific to that local market, and even to that local market segment. Within a suburb, a beachside town, there are markets within that market at different price levels. We also provide advice on when to sell, when will be the prime time, or the time that's going to maximise your chances of getting a great result. We talk them through their individual scenario, and if the matter isn't time urgent, maybe our recommendation is this is what the place is worth now. In 12 months' time, we think it could be slightly more, slightly less. Maybe it's time to bite the bullet and meet the market now, or alternatively, maybe if you've got time on your side, let's hang off for a bit and see what happens in the next 12 months.
Just getting that data and clarity. I know the conversations we have, people just get swept up in that confusion. You just get it as a fact, basically, from you guys with here's your sort of current advice, here's your upside, downside potential, and then we work back through the equation with their financials.
Well, ultimately, you just give the data, and then you can make the decision as you're the client. So, you pay for the advice, we'll give you the advice. But that might be also how to sell a property or how to try and buy it. And then if you need to sell a property, who's the best agent to deal with? Like we're dealing with agents all the time. Like we see different
There's
ways.
no kickbacks. I can guarantee there's no kickbacks.
The thing with that, you said this earlier, is knowing your patch. Like those agents who, from what we, again, this is probably personal opinion, but what we see is the ones who are in those communities, know them, and are specialists in them, are usually the better agents to deal with. You get ones who are floating all over the place, or sometimes they come down the highway from Melbourne trying to sell a place for a friend or something. It doesn't seem to work very well very often.
I guess in your industry as financial planners, there must be other financial planners who are trying to be across everything, not particularly well, rather than concentrating on what they know intimately. And that's what we're trying to do with our company. I do all the coastal stuff along with my colleague Harley, who's lived in Queenscliff all his life. if I give him a property and say, "Oh, what do you think this is worth?" He knows.
It's probably been inside.
Yeah, he's like, "Oh, that's Mrs. White's house. We used to have
Yeah.
campfires out the back." You know, he's
They
he's
buried
an
asbestos there a couple of years ago.
Yeah, and then we've got James, who does a lot of our Geelong work. I do Geelong work as well, and a lot of our commercial stuff. And then we've got Frankie, who's a younger guy than us anyway, who's learning the ropes as well.
Well, maybe on that, on the sort of market insights and sort of trends, you mentioned it briefly, but we won't hold you to this, but tell us a little bit about, in your patches, what's going on, what you see happening in the next sort of 12, 18 months. We'll start with you, Jim.
Traditionally, I reckon we're in a pretty traditional market now, like Simon mentioned before. I reckon things have steadied in Geelong centrally. There's probably an oversupply of that B grade, C grade stock still, which is a flow on from the government tax initiatives.
So talk. What's a B and C grade stock?
So we might be looking at that apartment, so secondary apartment stuff, which doesn't have water views or a good aspect, may not have a car park, different things like that. Small 1-bedroom units, which are in 14 unit developments in on a main road. Stuff which in the boom markets, they look good, they look cheap, you can buy them on 2%, rent covers everything, and now it's like, we can't afford to hold this, we need to get rid of it. It sits on the market for 12 months because they're trying to get what they bought it for 2 years ago. The story. So I think throughout Geelong, the good period stuff, which good families always sort of want to live close to the schools, is still performing pretty well. Granted, you still mightn't be looking for that premium price it was 2 years ago, but I don't think you're too far off it as a general rule. And then the generational properties, which we've spoken about previously, either on the waterfront, Virginia Street, Retreat Road, like your absolute premium locations in Geelong still seem to perform well because you've got people that are waiting 5, 10, 15 years to get a look in on these properties. Yeah. So on the flip side, stuff that needs work, construction, any of the trades, that's still a bit iffy and people are worried about the costs. So I think whether that corrects a bit this year, I think there will be a correction in what costs are and how much renovations, cosmetic works will cost. So I think that might change this year as a little prediction because I think there just isn't as much work happening for those trades. So I think they're going to have to meet the market and people will start to go, okay, we can afford to do this now. It makes sense and it adds value to our property. It'll be an interesting year, I think, overall.
What about in the commercial space?
It's had a big adjustment. It was like someone flicked a switch in about the middle of last year, I think it was. It's always delayed after residential, but I guess the oversupply of probably factoriettes has been a big one in the industrial sector. There just seem to be every developer built 6 factoriettes on a block of 1,000 square metres and they range from 100 to 200 square metres. And it was fine during COVID when builders, landscapers, etc. were buying boats and caravans and wanted to store them somewhere.
Sheds.
But now money's become a little bit tighter and, there's a glutton of them to the market. So industrially, that seems to be a strong factor. The bigger stuff seems to be going all right, where you've got bigger businesses that storage facilities that need that space. Like that still seems to be okay.
But genuine storage, not boat storage.
Nah, proper, 1,000+ square metre sheds. Yeah. And then retail, Packington Street's had some good results recently, but if you drive up and down the street, there's still a lot of shops for lease. And then in towns, it's been well documented, but it's, not good in there.
What turns that around for the commercial stuff? Is that, or what do you think was that switch? What flicked it? What turned it?
It's a good question. I think generally it's a lag from the interest rates and people need cash flow return. So when you're looking at yields of 4%, but it's now costing you 6, 7, 8, and the difference is substantial on a substantial property, you've got to come up with a lot of money. So I think it just takes a while for that to work through commercially. I'm not sure why originally that happens.
And those sheds, a lot of them were purchased off the plan during COVID and people made money off them, or at least on paper. And some of them got out and now it's got to the stage where they want top dollar still, but the yield is now 3.5%, 4%, which is not. It's almost unheard of for industrial property, and they've got to get back to the ones that are selling and getting interest are at 6%.
Yeah.
So there's a fairly big gap between that, and I think the market will just take some time to settle, and people will hold on to their property generally. If they are under pressure, then they will sell and either make a small profit or a small loss. But it's something they'll have to accept if they want to move that stuff.
Do the longer leases on those commercial properties create that a bit of lag too, or is that not much of a factor?
Generally, if you've got a longer lease, particularly on that bigger stuff that James was talking about, that's an advantage.
That's an advantage.
Yeah, and the lease will probably be at a good, healthy clip, and the yield will be 5.5%, 6%, something like that, and you'll find a buyer.
Yeah.
How's that balance out against the Surf Coast, Simon?
Well, I spoke a bit before about the COVID boom where we had just silly prices being paid, people buying property unseen. It was as crazy as everything everyone knows. It was pretty wild time. Then interest rates went up, and there's been a readjustment. But the coast is operating in two halves. So owner occupiers are driving the market across the board. So towns like Torquay, where a lot of people live permanently, is operating a bit like Geelong. You know, people are upgrading, moving sideways, downgrading, just a normal residential and commercial market. Same with Ocean Grove. The prices have come back, but people are trading in and out. It's the ones that are driven by holiday homeowners and investors, which there's just an oversupply of property at prices from a year or 2 years ago, and there's just no purchasers willing to pay that at the moment. So the properties that are trading are meeting the market. You do talk to people, like you were saying before, Ben, that think, well, a couple of interest rate cuts and it'll go back to where it was. I don't think that will help. It'll take some time, first off. It sort of needs 6 or 12 months for people to get their budgets in order and work out, okay, can we afford a new house or to upgrade? So I think that's the first thing, and a lot of other changes can happen in that time. So I wouldn't be banking on a boomerang shaped bounce back. More of a
probably help
steady
the lower
flattening.
level. If we get a couple of interest rate cuts, it'll probably help the entry level the most. I think that sort of sub 700.
Yeah,
Well,
I see a lot of those first
market.
home buyers that maybe their serviceability just dropped off where they couldn't quite purchase, but they might have even had their deposit.
Yep.
But they just couldn't service, and the banks were a bit tighter with lending, so they just weren't able to, and they'll start to come back in, or they'll be a bit more comfortable entering, especially those single people in that price bracket. That's a tough.
There's a flip side to every story. You know, if everything was worth what it was in COVID, no one can afford to get close to anything. So with the adjustment we've seen in, like I said, in Lawn and Point Lonsdale, and you're starting to see properties that were unattainable become, almost attainable for a dual income household. They might be able to find a house in a really blue chip area of Point Lonsdale, which 3 years ago would have been, that's pie in the sky stuff. Yeah. So there's, some people's losses, other people's gains, and that's the property market in general.
Yeah, that's probably the cooling off that we needed. Like it was.
Yeah, it was unseen, unheard of, as Simon said, in 20 years, never seen anything like it.
Yeah.
But I think on the back of what Simon just said before with, that probably investor market and maybe retiree market with the land tax and different taxes that have been introduced, you've got a whole section of the market which was probably cashed up, you could say, that, used to probably buy their holiday house that was maybe going to be their permanent place of residence, principal place of residence in 5-10 years' time, but now they're all sitting on their hands because they're like, we're not paying $300,000 of land tax in that meantime.
Yeah.
So they're completely out of the market. So
that's
waiting.
a factor with land tax, as much as we probably talk about it. Like, to put some numbers to that, like what would be, that some of those places are down in Point Lonnie, if they're worth a couple of $1 million, what would land tax be ballpark on something like that?
It's on a sliding scale. I don't have it in front of me. But
we're talking tens of thousands.
Absolutely.
I think that's the key thing.
Yeah.
We're not talking about
We're not talking $500 or even the rates. It's
20,
and
30.
it's going to go for 10 years. It's
that's what I
scheduled to
mean.
go
So
for
I
10
think
years.
people hear of land tax and they sort of, there's a bit of a, in the past you might have got a $200 land tax bill. They're these are tens of thousands of dollar bills.
Yeah, look,
on
up
property.
to $1 million, it's probably absorbable by
Yeah.
most people in terms of your land value. It's
Yeah.
based on your site value as assessed by the council, but it's a sliding scale, and once it gets up, they're good problems to have for these people. They're talking about a $2, $3, $4 million land value. They're not poor people, but they may be cash poor.
Yeah.
And this property, they've been lucky enough to have had it through the family for 50 years.
So on that front, so what you get your land tax bill, and you look at it, and it blows your mind. You don't have the cash, and you think, what do I do about this? Like, where do you guys fall in to that process of people wanting to challenge sort of what they perceive as inaccurate valuations?
Yeah, and there's been some really inaccurate ones on the Surf Coast, which we've had some hand in objecting to. We've had someone in Anglesey who, like I said, a wealthy person, good problem to have, but he was getting slugged twice as much as he should have, and his land tax bill was $80,000 or $90,000 a year. We had a look at it and said, no, that's not right. They've made a mistake here. It was almost like they'd ticked the wrong box or put multiply rather than plus in the spreadsheet. It was so far out. So we challenged it, and we were successful with that. So that saved him about $45,000 a year. For the prior, our fee was probably a couple of $1,000s in that. So yeah, they're not always contestable. Sometimes you have to wear it, but
Sometimes they're right. Sometimes you're getting away with it.
I'd say sometimes you're on the good side.
So yeah, we've been looking at them pretty much. If someone calls us up and says, do you think we've got a case to answer, we'll have a look at it briefly for free, and we'll either say, look, no, I think you unfortunately that's about accurate, or yes, we can do something, and then we'll put a proposal together.
I was going to say that's probably the process. Get your land taxes, make a call to you guys, and in the end you probably look at it in 5 seconds on some of them and say, no, that's pretty fair.
You just got to
yeah.
get that time frame right too, because
Okay.
there is a timeline that needs to be adhered to.
You have to object within 2 months of receiving it, and then the council's got 4 months to give you a response. In the meantime, you have to pay your land tax, otherwise you get a little tick on or a cross on your credit,
Yep.
and then they'll work out if they're going to refund you later on. It's a
heavily
arduous
biased.
process. Yeah.
Gotcha. That's where you need you guys to make sure they follow it. So
Yeah, and when we do it, we deal with the whole objection. We
Yeah.
deal with council. They correspond with us, and we go back to the landowner at the end and say, look, this is our recommendation. This is what we've got to. What do you want to do?
On that idea of the cost of not getting advice or getting bad advice, what are some of the other worst mistakes people make in terms of either not getting valuations or getting poor ones? Like the land tax one's I think it's a pretty relevant one. It's worth, talking to you guys about it. What are the other examples that you've seen of people making mistakes with property valuations that burn them?
Well, probably with not getting property valuations, we've talked about buyer's advocacy, and it's something James and I are looking into expanding in our business, purely on the back of what we see going on in that industry. You often see a buyer advocate come down and they're in the Geelong Advertiser saying, we bought this property for this client, what a great deal. And we'll ring each other up and go, what, they paid that? It's $150,000 over reserve in a depressed market. The place has been in the market eight months or something like that. And we think there's got to be a better way to doing this. It doesn't seem like a great deal. They normally charge about 1% of the purchase price. So yeah, it's something whether their clients think it was a mistake or not, I don't know. But from our point of view, we think we could have delivered them a lot more value. The other one is that estate planning stuff. For what it costs to get an expert out and someone who's intimately in touch with the local market, it's a no-brainer. Like, you just have someone independent. Don't go by what your brother who lives in Hong Kong says or anything like that. Get it done. It's quick. It'll take you less than a week. We're fully across it. We're happy to talk about it afterwards, beforehand, correspond.
It's driven by data, not emotion. That's the biggest thing, I think. They're the facts. They don't lie. And our experience details that. And then you can go forth and make the decisions from there. But it's not emotion driven, I guess. Is the main
death
thing.
and divorce are probably the two most emotional, scenarios we come across. And we see people, they're emotional, and you're just trying to cool their jets, be objective, and get data accurate. And that's where it's invaluable. Then you make proper correct, best placed decisions moving forward.
And I think we talk about this ad nauseum on the podcast, but the idea of actually having a team, I mean, what you said, Simon, about moving into the sort of the property advocacy world, I think what we see is that clients actually do, maybe they want it or they need to have an ongoing relationship. That's what I think. Like if you're in the property world, so you're an investor, you're spending a bit of time, even if you're not, like even if you want to actually have a group of people around you that can work together, like every implication you have from a property valuation point of view probably has some sort of implications from a tax point of view, so that you need your accountant involved. You're going to do something with those funds, either invest them somewhere or they're coming out of a super fund or they're going into another investment vehicle. So you probably need your advisor, your financial advisor involved at the same time. I think that idea of having like a group of trusted professionals that can help you make those decisions is the direction of investment markets more broadly. And that's what we've seen, that we don't sit in isolation to people like yourselves or the accountants or the solicitors. Our aim is to actually work very, very closely with them. So whether it's an estate planning issue, whether it's a family law issue, whether it's just an investment decision, it's so important to have the right people that have expertise in their area working as a collaboration. If you don't have that, again, you tend to rely on emotion. You're not very objective. And I've probably said this on every podcast for the last 100, that that's where we add value. That's where we add value of being independent in the advice that we provide.
And our advice is always to use our advice, but use your own opinion at the end of the day. So we'll give them all the data. So take a pre-purchase valuation. Someone's okay, I want to buy this. The price is 1.6. I'm happy to pay that. I want you to have a look at it. I might go out there and say, look, I think it's worth 1.5. I think that's a fair value. That doesn't mean don't buy it for 1.6. But they know. Okay, well, if I have to resell it in the next 12 months or 18 months, I might be looking at 1.5. But I really love the property. It suits me down to a T. I'm prepared to pay that. And that's where knowledge is power. So they know that from the start. They know that, yes, we paid slightly over, but we're okay with that. Our job is not to tell them, don't make that decision. Just make an informed decision.
Yeah, even it's like people try and pick the bottom of the market to buy a property. And if you plan to buy this property, it stacks up, it meets all your needs, and you're buying it at the fair price at that time, and you plan to be there for 20 years, then that's okay. But you need to get all that information lined up first before they make that. People try and hold out and trying to get a bargain. They end up missing out.
I think one of the points that you've made on previous podcasts is that one of the mistakes people make is that when they decide that it's time to buy a property, they maybe haven't got their ducks lined up. So they haven't got their cash flow lined up. They haven't got their finance lined up. They haven't got all the other tax implications lined up. The best thing you can do is actually be prepared in advance of the decision that you want to make. Now, it doesn't always turn out that way, but if you can, then you've got objective information. You can make an informed decision. You can be relaxed about it. You not be stressed about what the market may or may not do, what interest rates will do. You know that it's actually going to sit comfortably in what you can afford to do.
We often say like it's their micro economy, like their household economy is what drives whether they can or they can't do it. And you not ignore the macro. You got to be conscious of it, but don't let the macro control your economy and your household. People who aren't in a position, and probably back through when people were buying properties through COVID, they thought they had to. They didn't actually consider whether it was the best thing for them at that time or if they could withstand interest rates going up. They just thought that FOMO thing, they had to. So when the macro drives their micro, that's what throws the whole thing out of whack.
I think you're right, and I think there was some incredibly strange decisions being made off the back of living in a house with 3 kids and your wife or your
Everyone
partner for 6 months and not allowed to leave the house apart from to go walk your dog. You can understand why people might have made some irrational decisions.
Outsmarted themselves. Yeah, this is what we're going back a little bit, but I think people are fascinated by this. If you had to pick a suburb or a location at the moment around down the coast or here, where do you think the best value would lie at the moment on a long-term purchase? Like where, you probably maybe already talked to this a little bit, but where do you think for both of you that you would say, based upon what's happened in the last couple of years, this is, from a long-term data perspective, the best value at the moment?
I'm personally an advocate for that inner ring. So Herne Hill, close to the Minerva Road, somewhere in there, even Hamlin Heights, close to Vines Road. Like, you can get a 60s brick veneer or weatherboard on 650 square metres somewhere in the range of anywhere between 600,000 to 700 grand.
Yep.
And you're close to the freeway, close to the shops, close to town. You can pretty much take your pick about what you want to do on the weekend. A few shops to walk to, drive to, go to Melbourne. Very flexible location, schools everywhere, ovals, playgrounds. I think it's bang for buck compared to 800 grand for a 400 square metre, 4-bed, 2-bath Simmons in Armstrong Creek. Just makes no sense to me.
Yep.
But there's a bit more work involved in the Herne Hill project. But I think long term, I think there's value there for sure. And then I think, if you're willing to take on a project and you don't want to pay top dollar, but the secondary peripheral areas of Newtown and Geelong West, for example, I think there's value there because you can get good sized blocks at the moment. Like you're looking at maybe $1,000 a square metre for land rates in secondary Geelong West. Well, you're paying 900 in Armstrong Creek. Where do you want to, I know some people want to live in Armstrong Creek, but as a general rule, where would most people rather live?
Yeah. And that's probably based upon, access to facilities, infrastructure, train, like all those things. Like those things. You're so much closer.
Value drivers.
Yeah.
You got the train right there. I'm obviously moved to Geelong 3-4 years ago, but I love it. Like the elements that we get exposed to here, it's easy to jump on the train. The coast is half an hour away. Even if you want to go inland or the wineries, etc. I think Geelong has, so many good attributes for it. If we can just improve our CBD a little bit in different elements, I think there's still a lot of growth for Geelong as a broader region.
But you, Simon?
I agree with James about Armstrong Creek to a degree, but I think it's a wonderful place to live out there. If you're a young family, you are 10 minutes to Geelong CBD. You can have a modern house that you don't have to maintain or renovate. You're 10 minutes from some pretty amazing beaches down the surf coast. The prices are pretty comparable with the estates out in the outer west of Melbourne. And if I'm able to work 2 days a week in Melbourne or something like that, and the rest from home, I know where to, and they were the two choices. I'd be choosing Mount Dunedin, Armstrong Creek any day of the week. I think it's certainly got its place. Down the coast, I think unless you're an owner-occupier, there's probably better options at the moment. But for an owner-occupier, upgrading, downgrading, moving down here, it's time to pick the eyes out of the market, and there are opportunities there. I can't say that they won't be worth slightly less next year, but I can almost say with certainty that in 10 years you won't be regretting your choice to sort of, if you find the right place at the moment, maybe rely on some advice, but there's some really great opportunities which I didn't think would come up again. And land tax might get revoked in 10 years. There was meant to be a 10-year
temporary measure.
COVID repayment plan. So if you can sort of avoid that for a little while, you might come out on top. Going forward.
So is that your point, Lonnie, Torquay, Anglesea, sort of?
Yeah, they're probably the areas that have come off the most. But it really only works if you're an owner occupier and you're there for the next 10 years or 15 years. You can buy into neighbourhoods now, which you probably thought were unobtainable. Yeah.
I think that's the key. It's long term.
Yep.
And owner occ,
it's long-term lifestyle investment too. Wonderful place to live.
Yeah.
If you can walk to the beach within 5 minutes from your house, I don't think you'll regret your choice. Yeah.
Beautiful.
We talked a lot about data today, and you mentioned maybe the move into property advocacy a little bit, in a bit more in the future. What is the future of property valuation? AI is obviously probably noteworthy to talk about. Is it going to replace you guys, or does it enhance what you're all about and how the services that you offer in the future?
I definitely won't replace us. There's a part of the market that wants to rely on it, but specifically the banks want to use it as much as possible, and they've got objectives which are different to you or I. So they want a valuation that is close-ish, and it serves a purpose. And AI, for the vast majority of times, is capable of doing something reasonable. But at higher value levels, whenever you're making a decision that's important, you need someone with experience and with knowledge and with a cool, calm head. I'm sure that's the same in your industry, Jay, where experience and knowledge will never be replaceable.
Yeah. Well, I think that, again, we've said this many times, is I think that AI and tech will help us with sort of objective data and filtering that objective data, but it doesn't help greatly. I don't think it's going to help with relationships, and it's not going to help with subjectivity. The people that actually, like you've said, you live in and around the area that you're advising on, people who know people, a particular property and the quirks thereof it, that objective data just might not be available. You combine the objective data with some of the subjective elements of knowing the area and the people and people's opinions and tolerances, combine those things together. In our world, and I think in your world, it probably helps those people that have businesses that are built on relationships, so you can have the best of both worlds. You have the objective data that you have at easy access to at your fingertips, but you then can use what you're good at, and that's actually understanding your area of expertise and the people that you operate with every day.
And that's exactly right. So the AI is as good as the data that gets put into it. So when there's plenty of data, all the blocks are level, all the houses are 5 years old or less, it can spit out a figure that's pretty accurate. What it can't tell you is what James can, is which street in Geelong is the best, which block within that street is the best, where does everyone want to live, and that's what he can tell you.
I think it's the help. It's not going to replace, but it helps. And I think, like Simon just mentioned then, on a map, Retreat Road can look similar to a Fraser Street, but they're not the same, but they're 100 metres away. Yeah. And the other element, like, how many properties are we going through a week as a team in Geelong,
150?
Yeah. Like, properties come to market, there's a fair chance we've been through it in the last few years. Yeah. One of us in our team. And that goes for our whole business across Australia. So, I think it goes back to what we were talking about before. The fee you pay for the information or the data, you do see that as a 6 or 7 page report or whatever it is, but there's a lot more that goes into it behind the scenes and in previous years that you don't have access to unless you ask.
So, how can people find you? Whereabouts, Simon? Someone's got a quirky estate issue. They need to get a hold of you, or they got their land tax that they want to question. Who are they calling?
Can Google WBP Geelong. They'll find me there. They won't find me on too many social media sites, unfortunately. Jim's a bit better than that.
I'm a little bit
You're
more
the face
prominent.
So they'll get through to the Geelong office. They won't go through the Melbourne office.
They've got our details on the website. They can get through us to the Melbourne office. Yep.
All our admins ran out of our head Melbourne office.
Okay.
But yeah, our website's got our email details, anything you need to know, and yeah, we're happy to have a chat before engaging us and seeing if you like what we have to offer. But yeah, we're an open book.
Beautiful. Well, hopefully everyone that's listened today has got a bit more insight into property valuations and whether you're an owner or an investor. You understand some of the value of actually seeking out professionals to give you advice on things that you're not that well versed on. So, Ben, you got any other closing comments before we wrap this up?
I think it'd be good to do again 6 or 12 months and check back in on
predictions,
what's been happening. Again, the world changes rapidly, so it's always, and I think having these, people are fascinated by property because it's one of those things, especially you sort of saying that the under 40s have only seen it be positive, and there's a lot of people in that generation above who've made incredible money out of it. So the bias towards I must have some of that is a big pull for people. So anything with property, it clicks pretty hard. So
well, I vividly remember one of our colleagues who lives and works in the east of Melbourne and is probably on to about his 16th or somewhere around there, the new build flip. And he always said, he's like, people's biggest asset is usually their family home. So you need to treat that with the utmost respect because that is, what they value the most. And that's how we, every day we're in somebody's living room, bedroom, seeing how they live, seeing their property. So you got to, you take that that role very importantly. So yeah, that's what we do.
Beautiful. Well, good way to wrap it up. Thanks. We look forward to maybe a round 2 at some point. Well, maybe before 6 months. We'll get in a bit earlier than that. Thanks, Simon. Thanks, Jim.
Thanks for having us.
Thanks, Ben.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.